All right, so we've got a pretty interesting mix of stuff to look at today.
Yeah, it looks like we're going deep on value unlocking this time.
That's right. We've got investor presentations and management commentary and market analysis, and it looks like we're focusing on Kotak Mahindra Bank specifically.
Oh, yeah. Interesting choice, especially for fiscal year 2023-24.
Why do you say that?
Well, I mean, you look at that economic landscape, it was volatile, to say the least.
Yeah, for sure. I mean, even just glancing at this management report and analysis, you'd see how wild it was. So,
Exactly.
like, India starts off FY24 strong, 8.2% real GDP growth, not too shabby.
Yeah, but then you've got all that
Understand.
volatile inflation and tight liquidity really threw a wrench in
Yeah,
things.
talk about a roller coaster ride.
And then on top of all that, you've got the government trying to consolidate fiscally and the RBI taking a cautious stance on monetary policy.
So it's like a perfect storm brewing.
Pretty much. It
Yeah.
really sets the stage for the decisions Kotak Mahindra Bank had to make that year.
Okay, so that's the backdrop, this crazy economic environment. So, like, how did Kotak Mahindra actually perform in all of this?
Well, if we look at the Kotak Ma Bank.pdf and the management report, you can see that they did more than just stay afloat.
Okay, so they didn't go belly up. What they do?
Well, their PBT and PDT both jumped significantly from FY23 to FY24.
Hold on, PBT. What are we talking
Okay,
about here?
right, sorry, PDT. That's profit before tax, and PAT is profit after tax.
Oh, okay. So basically, how much money they made before and after taxes.
Exactly. And those are some of the key numbers that investors look at to figure out how healthy a company is financially.
Right, makes sense. So Kotak Mahindra's PBT and PBT are up. That's a good sign. But was that just them riding the economic wave, or is there something more going on?
That's the million-dollar question, and that's where this value unlocking thing comes in. It wasn't just luck. They made some strategic moves to actually create value.
Okay, so let's break that down. This management report mentions that they've got a pretty diverse portfolio of operations. They weren't just doing one thing, were they?
Not at all. They offered a whole range of financial services through different subsidiaries.
So like a one-stop shop for all your financial needs.
Yeah, you could say that.
Yeah.
And that diversification is key, because it helps them spread the risk.
So if one area is not doing so hot, they've got others to balance it out.
Exactly. It's like not putting all your eggs in one basket.
Makes sense. But within that diverse portfolio, did any specific areas stand out like real growth drivers?
Commercial banking was a real standout, especially their construction equipment and tractor farm equipment segments.
How much growth are we talking about here?
Construction equipment was up 24% and tractor farm equipment was up 9%.
Wow, those are some impressive numbers.
Yeah, they were really tapping into some high growth areas.
So diversification seems like a key part of their value unlocking formula.
Here-
What else were they doing?
Well, one big focus was on digital transformation.
The digital age.
Yeah.
Everyone's talking about it, but did it actually make a difference for Kotak Mahindra?
It did. They invested heavily in technology, particularly their Kotak Fin platform.
Okay, what is it?
It's their digital banking platform, all their financial products and services in one place.
Like a one-stop shop online.
Exactly. And the management report shows some pretty impressive results, like a fourfold increase in users and a 60% jump in transactions.
Whoa, a fourfold increase. That's huge.
It is. It shows how they actually translated digital efforts into real business value.
Okay, so diversification and a big digital push.
Yeah.
What else did they do to unlock value?
Well, they also made some strategic acquisitions and divestments.
So they were buying and selling parts of their business.
Yeah. But not randomly. There was a method to it.
Okay, so give me an example.
Well, they completed the acquisition of Sonata Finance, which really boosted their microcredit business.
So they were expanding into new markets.
Exactly. They ended up with almost 27 lakh customers in that segment.
That's a lot of customers.
It is a significant expansion, but they also sold off part of their business.
Really? Which part?
They divested a 70% stake in Kotak Mahindra General Insurance.
Why would they do that?
Well, they sold it to Zurich Insurance and got a pretty hefty gain from it, 3,519.90 crore.
Okay, so that's a smart move, getting rid of something that's not performing and reinvesting that money elsewhere.
Exactly, optimizing their portfolio to focus on the areas with the most growth potential.
So they were playing both sides, expanding in some areas and streamlining in others. Sounds like a pretty sophisticated strategy.
It was. But of course, there were some bumps in the road.
Oh, I bet. No business is immune to challenges.
For sure. And the management report is pretty upfront about the headwinds they faced.
Like what?
Well, tight liquidity and rising interest rates really put pressure on their net interest margins.
Okay, hold on. What are net interest margins and why do they matter?
Sure. Net interest margin, or NEM, is basically the difference between what a bank earns on interest from loans and what it pays out in interest on deposits.
Okay, so the bigger the difference, the more money the bank makes,
Exactly. And these external factors, tight liquidity and rising interest rates, were squeezing that difference.
making it harder for them to make money.
Precisely. And you can see that in the numbers. Their NIM actually dipped a bit from FY23 to FY24.
So they're facing external pressures on their profitability. What about internal challenges?
You're right, they had those too. Employee attritions, especially in field sales, was a concern.
What were they doing to address that?
Well, the human resources section of the report outlines some initiatives they implemented, like career development programs, enhanced benefits, better training for managers.
So they recognized that they needed to invest in their people.
Exactly. They understood that retaining and developing talent is crucial, especially in a tough market.
So they're getting hit from all sides. Macroeconomic pressures, internal challenges, the ever-changing digital landscape. Sounds pretty intense.
It was, but they managed to navigate all of that and still come out on top.
How'd they do that?
Well, that brings us to another crucial part of their story, their risk management strategy.
Ah, risk management. In a year as unpredictable as this one, how do they ensure stability and protect shareholder value?
That's a great question, and one we'll explore next time. Well, they didn't just have luck on their side. They had a well-structured approach to risk management.
Okay, so let's dive into that. What did their risk management strategy actually look like?
So they followed what's called a 3 lines of defense model.
3 lines of defense sounds pretty serious.
It is. It's a multi-layered approach to making sure they identify, assess, and mitigate any risks that pop up.
Okay, so break it down for me. What are these 3 lines?
So the first line is actually the business units themselves.
The business units.
Yeah, they're the ones on the front line, so they're responsible for managing the risks in their day-to-day operations.
Sounds like everyone's got to be responsible for their own area.
Exactly. Then you have the second line.
Okay, what's that?
That's made up of independent risk management, finance, and compliance functions.
Ah, so that's like a dedicated team to double-check everything.
Pretty much. They oversee everything the first line does, challenge decisions, and make sure everything aligns with the bank's policies and risk appetite.
Okay, so the first line manages their own risks. The second line makes sure they're doing it right. What about the third line?
That's where internal audit comes in.
Internal audit.
Yep. They come in and do an independent assessment of how effective the risk management and control processes are across the whole organization.
So it's like having a separate auditor come in and make sure everything's on the up and up.
Exactly. It's like a final check to make sure everything's running smoothly.
So you've got the business units managing their own risk, then the risk management specialists checking their work, and then internal audit coming in as the final safeguard. That's a pretty comprehensive system.
It is. And they don't just have it on paper. They've got strong processes in place to actually monitor those risks and take action when they need to.
Can you give me an example of how that works in real life?
Sure, let's take credit risk, for example.
Okay, so like loans and stuff.
Exactly. They've got a very thorough process for analyzing loan applications, making sure they're only giving loans to people who are likely to pay them back.
Makes sense.
Huh.
So they're not just handing out money willy-nilly.
Nope. They also have strict collateral requirements to minimize potential losses if someone defaults.
Collateral. What's that?
It's basically something of value that the borrower puts up as security for the loan.
Oh, I get it.
Yeah.
So if they don't pay back the loan, the bank can take that collateral.
Exactly.
Yeah.
It helps reduce the bank's risk. And on top of all that, they also have an early warning system.
An early warning system for what?
It helps them identify potential credit weaknesses before they turn into big problems.
Yeah, they're not just waiting for things to go wrong. They're trying to prevent them from happening in the first place.
Precisely. It's all about being proactive.
So they're being proactive with credit risk.
Okay.
What about other types of risk?
They've got a sophisticated framework for managing market risk, too.
Market risk.
Yeah, that's the risk of losses due to changes in things like interest rates or currency exchange rates.
Okay, so how do they manage that?
Well, they do things like stress testing their portfolio.
What stress test?
It's basically seeing how their investments would perform under extreme market conditions, like a sudden crash in the stock market.
Oh, so they're trying to figure out what the worst case scenario would be.
Exactly. And they also use something called value at risk modeling.
Value at risk. That sounds complicated.
It is. It's a way of quantifying their potential losses from market movements.
So basically, they're trying to put a number on how much money they could potentially lose.
Exactly. It helps them make more informed decisions about how much risk they're willing to take.
So they're being very calculated about it.
Exactly. It's not just about hoping for the best. They're actively managing their exposure to all these different types of risk.
Makes sense.
Yeah.
But all this talk about financial risks, did they ever think about other types of risk, like reputational risk?
Absolutely. They know that a company's reputation is just as important as its financial assets.
Yeah, especially in today's world where everything's on social media.
Exactly. And the management report actually dedicates a whole section to managing reputational risk.
Really? So what are they doing about it?
Well, they really emphasize ethical business practices, putting the customer first, being transparent in everything they do.
So it's like they're trying to build trust with their customers and stakeholders.
Exactly, because they know that trust is the foundation of the banking industry.
So they're not just focused on making money, they're thinking about the long-term impact of their actions.
Precisely. And they even have specific guidelines for handling crisis situations.
So they're prepared for anything.
They're trying to be. They know that even with the best risk management in the world, things can still go wrong.
So they've got a plan B.
Exactly. It's all about being prepared and minimizing the damage if something unexpected happens.
That makes sense.
Well,
So they've got this comprehensive system for managing all these different types of risks. But with all that focus on avoiding risk, did it ever hold them back from trying new things?
that's a really good question. It's a delicate balance, isn't it?
It is. You can't be so afraid of risk that you never take any chances.
Exactly. You need to be able to innovate and take some calculated risks to grow and succeed.
So how did Kotak Mahindra manage that balance?
Well, that's something we can explore further. While their risk management framework seems pretty solid overall, it's possible that there were times when they were overly cautious.
And that might have cost them some opportunities.
It's possible. It would be interesting to see how they approach risk-taking going forward.
Yeah, for sure. But looking back at fiscal year 2023-24, it seems like their strategy of diversification, digital transformation, and a strong risk culture really paid off.
They definitely had a good year. Their approach offers some valuable lessons for any company looking to unlock value.
Yeah, I think so. It wasn't just about taking big risks. It was about managing those risks effectively while still going after growth opportunities.
That's a great point. It's a delicate balance.
It is. Okay, so we've covered a lot of ground here: financial performance, strategic initiatives, risk management, corporate culture. But I think we need to take a step back and connect all of this for our listeners.
I agree. It's important to see how everything fits together to create that bigger picture of value creation.
So if we had to sum up the key takeaways from this deep dive, what would you say are the most important things for our listeners to remember?
Well, what stood out to you?
For me, it's their holistic approach to value creation.
Yeah.
They didn't just focus on one thing. They had this multi-pronged strategy:
Exactly. They were doing everything right.
diversification, digital transformation, smart acquisitions and divestments,
Yeah.
a strong risk management framework. They were firing on all cylinders.
Exactly. It shows that it's not just about doing one thing well. It's about getting everything working together.
It's like a well-oiled machine.
Precisely. And it's not just about the numbers. It's about having a clear vision, a strategy, and executing it well.
They really knew what they were doing.
Yeah.
They understood their strengths, found opportunities in the market, and built a resilient organization that could adapt to change.
You got it. That's a key lesson for any company looking to unlock value.
Yeah.
You got to recognize that it's not just a destination, it's an ongoing journey.
A journey of adaptation, innovation, and smart decision-making. And sometimes it means making tough choices, streamlining your operations, and even letting go of things that aren't working anymore.
That's right. It's about constantly evaluating and evolving.
Okay, so Kotak Mahindra's journey in fiscal year 2023-24 is a great example of that. But what about other industries?
That's a great question. Can these principles be applied in other sectors?
Exactly. Could a tech company or a manufacturing company or a retailer use a similar approach to unlock value?
I think so. I mean, the basic principles are pretty universal.
Like what?
Well, diversification for one.
Right, not putting all your eggs in one basket.
Exactly. And then there's innovation.
Coming up with new products and services.
Right. And strategic portfolio management, making sure you're investing in the right areas.
And of course, having a strong risk culture.
Absolutely. It's all about finding the right balance between taking risks and managing those risks effectively.
So it sounds like these principles can be applied across a wide range of industries.
I think so. But the specific application will vary depending on the industry and the company.
Makes sense. So there's no one-size-fits-all approach.
Nope. It's about taking these principles and adapting them to your specific situation.
So it's not just about copying what Kotak Mahindra did. It's about understanding the underlying principles and applying them creatively.
Precisely.
This deep dive has focused on value unlocking in the Indian banking sector. But it's clear that these lessons can be applied much more broadly.
Definitely. It's about thinking strategically about how to create value for your stakeholders.
And it's a continuous process.
Always looking for ways to improve and grow.
So what's the one big takeaway for our listeners? What should they be thinking about as they move forward?
I think the main thing to remember is that value unlocking is not just for big corporations like Kotak Mahindra Bank.
It's for everyone.
It's a mindset, a commitment to continuous improvement, and a willingness to embrace change and take calculated risks.
It's about recognizing that there's always room for improvement, always potential to be unlocked.
Absolutely. It's an exciting journey.
It is. So keep exploring, keep asking questions, and don't be afraid to challenge the status quo.
You never know what you might discover.
Happy deep diving.
Yeah.
It really is like an adventure, isn't it? Constantly looking for ways to create more value.
Yeah. And the cool thing is that these principles we've been talking about, they can be applied in so many different ways.
Okay, so let's say we're looking at a tech company.
Okay.
They're all about innovation, but they're also facing tons of competition and the risk of disruption. How would they approach value unlocking in that kind of environment?
Well, in the tech world, value unlocking is all about being ahead of the curve. Being the first one to spot those emerging trends
Right.
and then developing those groundbreaking products or services that everyone wants.
Right, the next big thing.
Exactly.
Yeah.
Then scaling up quickly to grab a big chunk of the market.
Sounds pretty intense.
It is high stakes for sure.
What kind of risks would they need to manage?
Well, for one thing, they need to make sure they don't grow too fast too soon.
Right, overextending themselves.
Exactly. Or sacrificing quality just to get bigger.
Yeah, that's a recipe for disaster.
And of course, they need to keep a close eye on the technology landscape.
Because things change so quickly in tech.
All the time. They need to be constantly innovating just to stay ahead of the competition.
It's like running a marathon at a sprint.
Pretty much. Okay, so what about industries that are a bit more traditional, like manufacturing or retail? How would they approach value unlocking?
Yeah, good question.
Well, for those industries, it might be more about embracing automation.
To boost efficiency and lower costs.
Exactly. Or optimizing their supply chains.
Making them more agile and responsive.
Exactly. And of course, they need to figure out how to create amazing customer experiences.
Because that's what sets you apart these days.
Especially in a digital world where everyone's competing for attention.
Right. So we've got diversification, innovation, strategic portfolio management, risk management, customer experience. What else?
Well, we can't forget about sustainability.
Yes, sustainability.
Yeah.
That's a big one these days.
It is. Investors and consumers are really demanding that companies operate in a responsible way.
Both socially and environmentally.
Exactly. So value unlocking might involve things like investing in renewable energy,
Yeah.
minimizing waste, or developing eco-friendly products and services.
So it's not just about making money anymore.
No, it's about creating value for a wider group of stakeholders.
Employees, communities, the planet as a whole.
Exactly. It's about recognizing that a company's long-term success is tied to the well-being of the world around it.
Okay, so we've talked about value unlocking in banking, tech, manufacturing, retail, and even sustainability. What's the one big takeaway for our listeners?
The key thing is that it's not a one-size-fits-all formula.
Yeah.
It's a mindset, a commitment to always finding ways to improve.
It's about understanding your strengths, identifying opportunities, and building an organization that can handle the challenges that come with growth and innovation.
You got it. And it's a journey that never really ends.
There's always more value to be unlocked, more potential to be realized.
So keep exploring, keep asking tough questions, and don't be afraid to shake things up.
You never know what you might find.
Happy deep diving.
And that wraps up another deep dive. Thanks for joining us, and we'll see you next time.